Great. And now I'm very pleased to introduce our two speakers, Rachel Bass and Pete Murphy. Rachel is a senior research manager at the Global Impact Investing Network, also called the GIN. In this role, she drives research strategy, execution, and dissemination on a wide range of impact investing topics, including impact measurement and management, financial and impact performance, and market trends, among others. Rachel is a 2015 graduate of the Fletcher MIB program and is also a co-founder of FSIG. Pete is a manager of market building at the GIN, where he leads efforts to build consensus in the impact investing market and supports fund managers to develop impact investment funds and vehicles that meet investor mandates and target concrete social and environmental problems. Rachel and Pete are co-authors of the latest publication for the Impact Investors Response, Recovery, and Resilience Coalition, which we can also call R3. And that report will be the topic of our conversation today. So thank you very much, Pete and Rachel, for joining us. We are delighted to have you. But before diving into the content of the report, I'd like to provide a bit of background context. So 50 years ago last month, Milton Friedman published his defining essay where he asserts, and I'm paraphrasing, that the sole responsibility of business is to increase profits for shareholders. This has been a large topic of discussion over the past few years, and it was a topic of discussion last year in a Fletcher conversation revolving around the business roundtable's determination that stakeholder capitalism should replace shareholder capitalism. Nevertheless, Milton Friedman's essay shaped the trajectory of capitalism for the next several decades. And so I want to turn over to Rachel and Pete and ask, what is impact investing? And what is the GIN? And how do they challenge the assertion made by Milton Friedman 50 years ago?
Thanks, Rebecca, and thanks everyone for joining. It's great to see some familiar names and faces and also new names. I'm really happy that there's a group that's so interested in the topic of impact investing. 5 years ago, when I was at Fletcher, it was still kind of nascent, and I see it's gained a good bit of traction at the school. So Rebecca, I'm happy to answer your questions, and what I'll do is share my screen with a couple of slides, and I promise not to do too much slide content, but hopefully a little utility here. And maybe first just share a little bit of background on the GIN, the Global Impact Investing Network, where Pete and I work. We are the global champion of impact investing. We're a membership organization with about 350 members around the world that cover a broad range of organization types active in the impact investing field. So funds, insurance companies and pensions, banks, foundations, the whole 9 yards. We also produce resources and materials for impact investors, especially that content focused on impact measurement and management, including IRIS+, which is a system for measurement, as well as research and data on the market, which is where I sit. And so our goal is to help increase the scale and effectiveness of impact investing and to enable more investors to more effectively use their capital to create good in the world. And so what is impact investing? I know this is familiar to many of you, but just to level set with the GIN's definition, we define impact investments as investments that seek to generate a positive and measurable social or environmental impact alongside a financial return. So this definition has a number of critical components. First is the focus on positive and measurable impact. And what that really means in the day-to-day is this commitment to measuring and managing that impact. We see that as a distinguishing characteristic that differentiates impact investing from investing. Second, what you'll see here is the focus on financial return. We're not talking about grants. We recognize philanthropy also has a really important role to play, but it's not investing. That said, the financial returns in the impact investing space can range from risk-adjusted market rate returns to concessionary returns as low as capital preservation. And there's a role for these different types of capital to play in this broader sphere of activities. And then the last thing I'll flag in this definition is what's not included. There's no restriction by sector, geography, asset class. We think all investments have the potential to create impact. And if that intention and measurement is there, then they can really advance some of advance progress in critical areas. So that's just a little bit of background on where we're coming from and what we're talking about. Rebecca, I'll pass back to you unless you'd like me to keep going.
Sure. I will ask you a follow-up question. So given this dual objective of achieving social or environmental goals alongside a financial return, what are impact investors doing now in the context of the COVID crisis?
Yeah, great question. We've seen a lot of change in the last 6 months alone that has really shed a lot of light, a new spotlight on some of the inequalities that have long been persistent in our society, and also put a new emphasis on the importance of addressing climate change with a heightened urgency. And so these are the areas where impact investors really can play a fundamental role. And one of the things that has happened as a result of the COVID crisis is a new level of pressure on employment and unemployment and on other critical sectors that enable people to manage their day-to-day. Things like food security, access to finance, and other mitigation measures against some of the financial shocks that many people are experiencing right now. Access to stable and safe housing, and access to water and sanitation services, and all kinds of things that can be pretty easily disrupted during a time of crisis. And this is where there's been a lot of energy for impact investors to leverage their specific skill set and expertise in impact measurement and pulling capital towards some of these critical areas. And where we're seeing a leadership role, but also in many cases, a deepening of the experience that impact investors have long had in this space. So at the same time, we're seeing kind of an expansion of effort in some areas, and also new players coming into the market, recognizing that there's both opportunity and need. So these are some of the areas that have come into play that we've really been focused on during this time period.
Thanks, Rachel. Pete, I think you were about to add something.
Yeah, no, I was just going to say, the one thing that I would add is that, I think a lot of us felt at the beginning of the COVID crisis that this would be sort of a new challenge for impact and sustainable investors writ large, and that this might have significant sort of repercussions for the scale of the market and the sort of momentum that has built up over the course of the last 10 years. And I think what's been encouraging is, and we don't have great data for impact investing specifically, but within sustainable investing writ large, there's actually been a massive inflow of capital into sustainable investment strategies. And I think we can attribute some of that to what Rachel just mentioned, which is sort of increased awareness of the social and environmental issues that have been exacerbated by COVID and also brought to light by COVID. So in some ways, the sort of silver lining here is that there's a lot of attention on these issues, and that's actually being matched by capital allocation. So somewhat promising.
Yeah, and I notice a parallel there between the current crisis and the 2008 global financial crisis, which actually sort of around that same time was when the impact investing industry formalized and when the term impact investing started to be used in common parlance more and more. And I think there was a similar fear that given the global financial crisis that impact investing as an industry wouldn't necessarily take off or succeed. But despite that, perhaps the crisis, the economic crisis led to greater motivation to contribute to these sorts of capital allocation strategies. Do you see that same parallel today?
Yeah, I definitely think so. And I think it's interesting because in the discussions, at least that I've been having, and Pete, feel free to add, with investors, there's a pretty broad recognition that even though this particular crisis does have a lot of distinct characteristics and features, it also has a lot of patterns that you see in other crises, including the global financial crisis of 08-09, as well as the crisis that's associated with various natural disasters and some of the constraints that come along with that. and the crises that are associated with political upheaval in certain markets or other kind of unexpected or turbulent events. And so through the course of some of the research that we'll talk about, I've been hearing investors pull inspiration and insight from these other events to help shape the way that they're navigating the current point in time. And so I definitely think it comes into play.
Mm-hmm. I think one of the patterns that you've highlighted in this report is how crises disproportionately affect historically marginalized groups. And I know that the topic of this report is how to create resilience by building up social equity. So maybe you can dive into the presentation on the content of your report now.
Yeah, I'm happy to. So the GIN has been playing the secretariat function in what we call the R3 Coalition. It's the Response, Recovery, and Resilience Investment Coalition, where we have come together with about 12 other member organizations and networks to build a cohesive and coherent and collaborative agenda to help investors and entrepreneurs navigate the current crisis. And so one component of this is that the GIN has been spearheading a series of research briefs that look at different topical areas that have been really challenging for the market. The fourth installment, which I'm sorry to say did not publish today, but did publish recently, is focused on this idea of social equity. And that's because these inequalities that we're speaking about, even though they've been persistent for a long time, they have gained a new prominence in public discourse and a heightened urgency with some of the challenges associated with the current pandemic. I won't throw too many stats, but 40% of global jobs are considered vulnerable right now. 265 million additional people are hurtling towards food insecurity. The average American family has enough savings to weather about 4 weeks without an income stream. There's no shortage of really striking data points that emphasize some of this. And when you look at the effects by different demographics, it's even more startling. This is not a pandemic that's being felt evenly by all people. Everyone is being affected, but the greatest challenges are felt by some of the most vulnerable people in the world. And so what we've tried to do through this research is just better understand what that looks like and how impact investors are able to address some of these constraints. And so we've heard three main areas where social equity is particularly fragile. And these include areas related to poverty and socioeconomics, gender, and race. And these are, of course, intersectional and complex, and the way that this plays out in one country versus another is typically quite different. But at the same time, it's a common thread that we're seeing emerge around the globe, where there is an awareness that the kind of foundations of society are fragile. And so what we've wanted to do is just better understand how addressing some of these vulnerabilities can drive resilience in the face of future crises. And so that's led us to these three findings. One is, of course, investors do play a role. It's not to say they play the only role. They're working in concert with governments and philanthropic actors and the NGO community and others. But the private sector and investment capital more broadly is a critical input to driving some of this change. Secondly, is there's various ways to address some of these issues, including internally within investors' own organizations, as well as through the way that they wield their capital to influence opportunities on the ground. And I'll speak a little bit more about this in the next slide. And third is just that there's opportunity for more knowledge, more resources, more connectivity to help further advance and accelerate some of the progress that's being made on this front. So we see this as a starting point, but there's no shortage of work left to do to help move the needle on these areas. I can talk just a little bit about some of the different strategies we've heard. I won't go into too much detail, but if folks have questions on any of these, I'm happy to speak more to it. But essentially what we've heard is that there's a need to consider social inequality in every choice that investors are making. And this starts by integrating diverse perspectives in their own staff, their own investment committees, boards, and also ensuring that there's diverse representation among investees. This is very well associated with improved flows of capital towards vulnerable communities. Also a need to review the investment's context and understand just the history of marginalization and some of those cultural implications of that in different geographies. Many members of the GIN work in multiple countries, multiple regions around the world, and recognize that this is not a cookie cutter opportunity. There's a need for some customization. Third is thinking about deal sourcing and trying to do this in a way that reduces implicit biases. A common way to source deals in the finance world is through networks and through relationships. But this inherently biases some of that. And so looking at ways to more strategically democratize access to capital has been a really interesting area that investors are exploring. Factoring diversity, equity, and inclusion considerations directly into due diligence. And this includes due diligence into funds or other intermediaries, as well as due diligence into companies or projects that are more directly, although the way that plays out may differ slightly. Targeting sectors and business models that are really well suited to drive social equity. We heard a lot of discussion around some of the sectors I mentioned before. So food and agriculture with a food security focus, financial inclusion, employment models and supply chain strengthening, and then also areas related to climate, recognizing that the climate crisis affects different segments of the population differently. Ensuring that investment terms align to investment goals, so making sure that the capital is reasonable, the expectations are aligned, the time horizon is appropriate, and just thinking about what it is that the investee, the recipient of that capital, really needs to be successful, and trying to match that to the investor's goals. And then lastly is driving social equity through ongoing support. And we heard countless examples of investors adapting to the crisis and providing additional supportive services or relaxation of interest payment expectations or other adaptive measures to kind of meet investees where they are, and to do this in a way that helps position both parties for longer term success. And so lastly, and then I'll pass to Pete, is that we have, of course, heard a number of calls to action for additional information and resources that'll help move the needle further on these issues. And so the GIN is hoping to play a role in this, and we also recognize that there's a lot of other players that are active on this front, but trying to provide more information, more guidance, more forums for networking, especially with actors that are of diverse communities and diverse perspectives, and more partnership with the different players that can help accelerate progress in these areas. With that, I'll see if Pete wants to jump in and speak a little bit more about the product side of things.
Yeah, so I mean, I can just quickly mention them. These are more sort of like other things you can ask us questions about. But as part of the R3 coalition that Rebecca talked about and that this research was a part of, we hosted a series of co-investment convenings, which was basically an opportunity for investors to share deals that were in one way or another addressing some of the social inequalities associated with COVID-19. Some of them were like very specifically focused on health interventions. So looking at everything from alternative vaccine therapies to like primary care facilities in emerging markets, to like food security oriented investment strategies, which were focused on sort of like providing trade finance to farmers who have had supply chains disrupted or something like that. So we've tested about, I think, or looked at about 45 direct investment opportunities and about 12 fund investment opportunities through that work, and have seen a lot of really interesting stuff. I think we'll eventually be putting together sort of more direct summary of that. The other thing that I quickly wanted to mention is at the very beginning of COVID, almost before the R3 Coalition came together, we put together a couple of workshops that were oriented around developing new investment fund structures that are targeting sort of what I'll call economic insecurity related to COVID-19 in emerging markets. So basically, a bunch of companies who were existing investees of impact investors were facing some sort of balance sheet crunch. They didn't have enough liquidity, or they didn't have enough working capital. And there were a number of impact investors, fund managers, who wanted to raise more capital in order to sort of help those companies out, keep them from going bankrupt. And so we put together a series of workshops on that, and actually wrote a research report also focused on sort of the findings of that. That was very much focused on the economic impacts of COVID-19, but definitely happy to chat about that as well, if of interest. And I will stop now.
I'm going to throw up our email addresses in case folks want to reach out after the event, but I'll take this down in just a little bit so that we can go back to the video screens for Q&A. But in the meantime, Rebecca, back to you.
Thanks very much, Rachel and Pete. That was a really enlightening presentation. I have maybe one question for Pete to kick us off on the structuring side of things. I was wondering, you mentioned this report where you were referring to sort of capital mobilization to investee companies in emerging markets who were experiencing some sort of crunch. Could you maybe elaborate a little bit on one innovative structure and like how it actually plays out, how different players are working together to mobilize that capital? Yeah.
So, I mean, maybe just as a baseline, the single largest outflow of investment funds from emerging markets happened at the beginning of this year, so in the first quarter of this year. So that was like largest on record, more than 2008. And basically that was a function of, what we call a risk-off environment. Investors were, in a really sort of cautionary position and wanted to make sure that their capital was not going to be lost. They saw emerging market investment strategies as being among the riskiest, and so they pulled their capital back. That obviously left emerging market fund managers and the businesses that they invest into in a really tough spot. So the job of these fund managers who are building these innovative structures is to sort of convince that group of investors that actually now is the right time to invest in emerging markets, which is a really, from the beginning, like that's just a very tough sell for commercially oriented investors. And so I think the big thing that we saw with all 6 of the funds that we looked at in detail, they're all debt funds. They all had some element of blended finance. And I'll do like a quick background. I'm looking at Rebecca. Do you think everyone knows what blended finance is, or background's useful?
I think background would be useful. Thank you.
Okay. Yeah. Cool. Yeah. So blended finance is basically within an investment fund, the inclusion, and this also could be within a transaction, a direct transaction, but we'll talk about investment funds because that's what's relevant here. The inclusion of like different types of capital. So there might be a foundation who's providing capital that they would otherwise give away in the form of grant in the same capital stack, the same fund, as an institutional investor who has a fiduciary mandate and needs to make a high return, a market rate of return for their clients. And the reason that foundation provides that capital that otherwise would have been a grant is because they're able to get that institutional investor invested into a fund that might be riskier than otherwise they would be able to invest into. And so this comes in a bunch of forms. One of the most common ones in development finance is a guarantee. Organizations like USAID and other donor agencies have been doing those for decades. Sometimes it comes in the form of what we call first loss capital. There's a great report that the GIN wrote, which I think might predate all of us actually, that is on the use of catalytic first loss capital, written by another Fletcher alum, Hannah Schiff. And there are a couple of other types of capital, but really like the innovation, to answer your question, Rebecca, that we saw was that there's just a lot more blending involved. Like there were a lot more foundations providing guarantees. There were a lot more donor agencies, trying to provide technical assistance or grant capital in the form of first loss. The challenge with first loss, or the challenge with any blended finance for the donors, the foundations or the donor agencies, is to really figure out like, what's the appropriate amount of first loss capital for me to provide such that I'm like de-risking this market and we're able to get commercial capital in, but not such that I'm like padding the returns of the commercial investor. And figuring that out under normal times is like really, really challenging. Figuring that out in the context of like the market volatility that we saw in the immediate aftermath of COVID was like a total nightmare. And so it was a lot of just sort of like finger in the air, this sounds right, investors are willing. And I think what was cool about it was that everyone was sort of willing to move quickly and maybe abandon some of the sort of perfection that folks have sort of strived for in previous rounds of fundraising. So blended finance was really sort of like the big innovation that we saw.
Thank you, Pete. That was very helpful in sort of understanding how impact investors are addressing some of these capital crunches. I want to give everybody an opportunity to ask questions. So please, I haven't received any in the chat, so I hope that means that you all were waiting until the live Q&A portion, and that I see lots of hands raising up. Otherwise, I can talk with Pete and Rachel for the rest of the hour. I have lots of questions, but I want to make sure that everybody has an opportunity to pose their questions. Garima, I think I see your hand.
Yeah, hi. Thank you so much for today's session. I am not sure if you have covered this before, but I wanted to ask, if a small business which has been hit by COVID, how do they generally approach an impact investor? Like, what's the route to, reach the impact investor and convince them?
Yeah. I can take, Rachel, you should jump in also. I think the majority of the small businesses that we have dealt with, just by nature of who our network is, already had investment from impact investors. And most of, I think 5 of the 6 funds that I was talking about just there were developed by fund managers almost exclusively to serve their existing investees. So they have an obvious interest in making sure that their existing investees don't go out of business. And so they were raising concessionary debt basically for that purpose. I think it's a really tough challenge to raise capital from an impact investor anywhere, particularly in emerging markets, and then particularly during COVID. And it's an issue that came up, I think, in one of the earlier reports that we wrote, where there were a couple of philanthropic investors who are focused on emerging markets and who are focused on access to capital for small businesses, who were saying, we really feel like COVID is going to exacerbate all of the sort of existing power dynamics around access to capital. And it's going to make it even harder for businesses that haven't historically had access to capital to access it. And part of the reason for that is that everyone is operating, on a Zoom, from their home. And so if you already don't have sort of a relationship or the start of a relationship with an investor, it's incredibly hard to build that trust and start a conversation about a new investment into a new company virtually. So I think the unfortunate short answer is that it's a really big challenge, and I don't know that how many companies are successfully raising new capital from impact investors right now. But Rachel, what do you think?
Yeah, I don't know the answer either because I don't know that there is one. I mean, we do see a number of platforms where entrepreneurs need list themselves in search of capital. There's a new one that has emerged in the last few months called Abaca. It was developed by Village Capital, and I believe they work with a number of small and growing businesses as well as others, and that's one route. It's a new platform, so I think we're still kind of waiting to see the level of traction that it gains, but it definitely has gotten a lot of positive feedback so far. So that's one route, and then networking, which, as I mentioned, is a blessing and a curse. It's great in some ways to help find sources of capital, but in others, it does create some biases in just who you're connected to and who is connected to you. And so there's limitations to that approach as well.
Thank you.
Professor Shanna, it's a pleasure to have you, and I see you have a question as well.
Yeah, thank you guys. I wasn't sure, Rebecca, if that was a cue to jump in, but I thought maybe I'd just continue the discussion. I'm very intrigued with this idea of COVID prompting opportunities for additional funding. I mean, I know on the other end of this spectrum, and I'm thinking in particular of the government of Ireland, and specifically a strategic fund that Ireland has that is a double bottom line fund, where they carved out a very sizable portion of that portfolio to invest, specifically in COVID distressed businesses. And one of the challenges I think that is a corollary to the point you guys are making, is that how do you distinguish under these circumstances a business that would otherwise be sustainable, but is now struggling? And what I find interesting about that is the fact that there's potentially an opportunity for considerable outperformance if you're able to invest in a business under these circumstances, perhaps at a good value, and then have the crisis sort of evolve in such a way or resolve in such a way that these guys are back on track, and it actually accelerates their competitive posture and so the evolution of that business. And so I can see both risk in these things, but also the potential for opportunity and deal flow for particularly for investors that might be more open to looking for these kinds of kind of create, in some respects, creative opportunities. So I'm just wondering if you guys if you see any sort of parallels in broadly the impact space. I have one other. So Pete, you were talking about blended finance, and one of the things I'm also curious about with respect to blended finance and this idea of concessionary and not, because concessionary could play a role here, right? But are you finding at all, do you sense that the rigor that impact investors bring to a capital stack, that actually is encouraging the growth of some of the lower, sort of the first loss type contributions to blended capital, because what they're seeing is better and more rigorous monitoring by equity investors, including impact investors that sort of reside higher up in the stack. So just two things I'd be just curious to see what both of you guys think about those.
I can start on the first one. So we mentioned that there's a research series, and Pat, your question is the second brief in the series, which is really focused on how investors are navigating the due diligence process right now, and how they're identifying those standout opportunities. And so there's been a very strong emphasis on the triangulation of insights and data. So more reference checks, more background checks, more calls to other partners who've previously worked with entities to kind of confirm some of the detail in absence of site visits and in-person meetings. And then also a much scaled use of scenario analysis tools, and specifically scenarios directly related to COVID, to help understand, are the fundamentals of the business strong and in place and able to weather this storm, or are the fundamentals themselves lacking irrespective of the current crisis? And then it's been interesting because a lot of investors noted that they're not able to rely on past performance as much as they used to, and instead are emphasizing different data points now than previously. So specifically, cash flow management came up quite a lot as one indicator that was really valued at this point in time. This is also a brief that Pete and I co-wrote, so I'll pass to Pete to see if you'd like to add anything, and then you're probably better suited to take the second question.
Yeah, I mean, I think Rachel covered the vast majority of it, and actually that report covers even more. I think the one thing that I find really interesting about this is that it totally depends on where the investor is in the fund cycle. So, at the beginning of this, we heard from a lot of fund managers who raised capital and have a bunch of cash sitting around that they're waiting to invest, that like this is in some ways good for them because they'll be able to buy these companies at a significant discount, and their fund cycle is 8 years more in it, and so theoretically, hopefully, I pray to God, we'll be out of COVID by the end of those 8 years, and they'll be able to recognize the gains that resulted primarily from them buying it at a discount. For managers who are 6-7 years into their fund cycle and have already invested most of the cash, they're just like how they're not thinking about new opportunities. They're just thinking about like how do we sort of revive the assets that we need to dispose of in our portfolio in the next 3 years because we're on a 10-year fund cycle. So and it's what's interesting about that is that it's not a strategic choice when to raise a fund necessarily, or it's not a strategic choice relative to the world that we find ourselves in now. And so it's just sort of like, did you happen to raise a fund in 2000 and maybe 12 then you're probably not in a great place right now. But if you raise one in 2018, you're probably in a really good place to find those opportunities, if you can get through sort of the obstacles of virtual due diligence and all of those things that Rachel laid out. I think on the topic of, on your second question, I think to a certain extent, the rigor with which, if I understand your question correctly, the rigor with which managers are now sort of understanding social and environmental performance of the assets that they're investing into, it certainly makes concessionary capital providers, namely like foundations and donor agencies, more willing to invest, because they can be more confident that the impact that may have been achieved and that they would have gone through a rigorous M&E process with, had they put it into some sort of nonprofit organization, is actually achieving a same or similar result in an investment structure. What's challenging for managers is they want to sort of communicate that to the concessionary capital providers, but often an overemphasis on sort of like rigorous, really like thorough measurement systems is not sort of music to the ears of commercial investors. They want to know that they're finding good deals and are investing in those deals and making decisions in service of their fiduciary duty. And so it's a really tough balance for the manager to be like, on the one hand, like, yes, we're doing all this impact stuff, to this audience, and on the other hand, we're not, or we're not wasting time on that maybe. And it gets to the broader challenge of like managing blended capital stacks, which is like, if you have a pension fund or a sovereign wealth fund or really sort of profit motivated family office in the same capital stack as the Rockefeller Foundation and USAID and the MacArthur Foundation, like how can you say that you have an aligned LP base who are like fundamentally at odds with why they invested into that capital stack? So I don't know. So really, it's a tough sort of play for a lot of fund managers, definitely.
Pete, I think that answer segued really nicely into a question we received on the chat, which is sort of bringing it up a level. So this is from Stephanie Riskoff. Thank you for your question. She thanks you and Rachel for your insightful and interesting remarks. And she says, speaking as a former government official who has often had to find ways to prove impact of government policy, I'm curious about the foundation of how you define impact investing. What is a, quote, positive, measurable social or environmental impact? And who decides what is considered a positive impact? Is there a codified standard for positive impact?
Oof, this is a long question, long answer. Rachel, do you want to start?
This is the $1 million question, or $2.5 trillion question, I guess, but which is the amount needed to achieve the SDGs. This is a really great question and a thorny one, and one that is critical for the market, but also existential and philosophical at all points in time. So thanks for asking. So a lot of this is about differentiating impact investing from other forms of responsible investing. The dominant being negative screening. So taking out things that are bad, divesting from fossil fuels or guns and ammo or other kind of sinful industries or whatever the case may be to meet your given mandate. And ESG, environmental, social, and governance oriented investing, which is largely about risk mitigation, so protecting yourself from the downside. Increasingly, ESG models are also focused on value creation, but a lot of it is kind of a risk management tool. Impact investing is about creating positive, so kind of pushing in that positive direction. And so there's been a ton of work across the industry in the last decade on how do you really determine what impact is, and how do you understand impact, and how do you track it and monitor it and communicate it. And this is an area where the GIN has done a lot of work. So last year we released IRIS+, which is a system for measuring and managing and optimizing impact that helps kind of whittle down 600 different metrics to the 5 to 7 that are most relevant for a given strategy, and help standardize what those metrics are, how they're calculated, how they're disclosed and reported, how they're tracked, so that we can all be speaking the same language. It's a public good, it's available, IRIS. Yeah, there we go, thanks Mohit. And a really, really great resource that helps start to move towards some of that standardization. Another one that's worth knowing is the Impact Management Project, which looks at the different dimensions of impact. Impact isn't a one-dimensional figure, it's multidimensional. And so what the Impact Management Project, or the IMP, has laid out are 5 dimensions that are useful to consider to understanding any impact. And those are: who is being affected, what effect is being experienced, how much of that effect has been experienced, what's the contribution to that effect from the investor and the enterprise, and what are the risks to that effect coming into play? What might prevent that from happening? And so all of this is woven into IRIS Plus as well. And it's just one way to better understand those different aspects of impact. I could talk about this for hours, but I'll probably pause there and see if that's helpful, or if there's other content on that front that's worth digging into. And of course, Pete, feel free to jump in and add.
I think you got it.
All right. Stephanie, I know you chatted the question. So if you have follow-up, please do chat that in the box. I see a hand from Dean Chakravorty.
Yeah, hi Rachel, great to see you, and congratulations on great report and study. I was struck by the fact that one of the focus areas, and I think it was like 58% of your respondents said reducing inequalities is the focal point for a lot of the work in the impact investing space. And going into 2020, so prior to this year, we were already behind in terms of closing the gap in inequality across all sectors and all the different dimensions of inequality. I'm wondering whether the GIN or other preliminary as to what the impact of 2020 and the pandemic is likely to be when we come out on the other side. How much wider is the gap that we have to close? So even having some high-level quantification of that, and then the extent to which that gap has widened in certain communities, such as women, for instance, have been disproportionately affected by the pandemic. So women-owned businesses or businesses that employ large numbers of women have been disproportionately affected. Black and Hispanic communities here in the United States have been disproportionately affected. In other parts of the world, certain disadvantaged communities have been disproportionately affected. So when you look at the gap, there is a gap at a macro level, and then there are gaps that are even wider, proportionately speaking, among traditionally disadvantaged communities. So sorry for the long question, but I'm sort of curious about whether you guys have started doing some analysis of how big this gap is likely to be, and if that is filtering into the discussions that impact investors are having now in order to gear up for the even bigger challenge in getting to the SDG 10 goal that lies beyond 2021.
Yeah, great question. And it's a sobering reality that the gap is very likely to grow during the course of this year. And for the first issue brief that we released in this series, we looked at a lot of this specific topic. So how these different issues are playing out and creating more need for impact investment, and how impact investors are adapting to address some of that need. And the stats are really sobering. An estimated, I think 265 million people are going to be facing food insecurity for the first time by the end of this year. I think it was the AFTA Network of Development Entrepreneurs found some stats that said that 42% of small and growing businesses face likely insolvency over the course of the next 2 quarters. And any number of other stats that speak to this. I believe that the World Bank is doing a fair bit of research on this, as well as the UN, which will help provide some of those macro statistics. But what we're seeing among the impact investing community are just candidly different responses to the crisis. Some investors are holding back a little and unable to deploy capital right now. Their own funding is also constrained as a result of this. And so depending on where they are in their funding life cycle, they may not be able to make as much progress as they had initially expected during 2020. And others are in a position to really step up and actually increase their capital deployments. I think we found almost 1 in 5 impact investors was expecting to allocate more capital over the course of 2020 than they had thought they would. And so how this plays out in terms of aggregate capital flows, I think the jury's out and we'll see. But the reality is that it's unlikely to be enough to prevent a widening of some of these inequalities and these gaps. And the only other thing I'll say is that the stat you cited is a really interesting one, right? It's under 60% of investors that expect to directly address reduced inequalities in terms of their SDG alignments. But they are also indicating alignments to other SDGs that inherently touch on inequality. So no poverty, no hunger, other issues that are related, even if they may not explicitly see it that way, which is a really interesting area where I think we're starting to see the investment community recognize that they are directly connected to this, even if that might not have played into their thinking prior to the pandemic. Pete, anything that you would add?
No, I mean, I would just say that I don't think we're in, as a small organization, the best place to answer research questions that are like quite that global. Maybe a job for academics, if any of you are interested in helping us out on that. That being said, I think our focus in the coming year is as an organization is increasingly targeting very specific social inequalities and trying to coordinate investment activity around those. And so we actually have a series of sort of investment workshops this fall that are focused on gender lens investing strategies and driving more capital to women-owned and women-run businesses, and maybe doing so in a way that is more thoughtful than previous gender lens strategies that focus on, in the words of my colleague who led our gender lens working group, counting women. And we have a similar series that's focused on driving capital to particularly investment funds that are led by and created for people of color in the United States that will be kicking off in the beginning of next year. So while we don't know the total sort of widening, what those numbers will look like, I think we feel like there's a real sort of impact investing wide focus on these issues, and hopefully we'll be able to mitigate some of the likely damage that's to come.
Thank you.
Thank you. I think we may have time for one more question, and I see that there is one already in the chat. And I think this one also gets at a very fundamental question of impact investing. So this is from Kamal. He thanks you both and mentions that, he says, I've worked in the social impact space, and I've always seen this tension between return on investment and the need to create some kind of impact through the investments. Has there been a change or shift in the way that impact investors are trying to balance these two aspects better, especially in the last 6 months?
Rachel, do you want to take the?
I'm sorry, Kamal is a she. I apologize for misgendering.
Yeah, I can take this one. Thanks for the question. I think the biggest shifts are, at least to my mind, twofold. One is there's growing recognition that there's a whole bunch of different levers that impact investors push and pull when they make decisions. Even in mainstream investing with no consideration of impact, you're still making choices all the time. You're trying to balance risk and return. You're trying to think about the time horizon that's appropriate for you. You have all kinds of internal considerations as well. And in impact investing, there's an additional variable of impact. And so what this really has kind of manifested is, I think, a moment of empowerment. Impact investors have choices to make as opposed to trade-offs to accept. And that's, maybe just a different way of looking at the same issue, but one that hopefully is one of strength, that impact investors can factor this in a new way. And then the other thing that's definitely evolved over the course of the last year or so is that we know more. We're learning a lot more about impact performance. The GIN has played a leading role on this front. So we released pilot studies last year in 2 sectors, clean energy and housing. And we have 2 more studies coming out in 2 weeks on agriculture and financial inclusion that are meant to help understand what do impact results look like. And with that information, you can factor it into decision making a lot more materially and directly. There's a long way to go on this front as we start to look towards performance management tools and resources like benchmarks and ratings and things like that. But it is a step in the direction of just having more knowledge and information about impact performance so that you can make better choices on these different tensions that may exist.
Yeah, and I might just quickly add, like, I think to Rachel's point, like we are now at a point in the market where we can say that like there is not a sort of one-to-one trade-off between impact performance and financial performance. You know, there's a ton of work that our research team in partnership with a bunch of consulting agencies have done to sort of categorize returns in that way. And I think the other thing that we've seen, and this is true of the sort of broader sustainable investing market, more so than impact investing specifically, but a lot of sort of ESG oriented funds actually outperformed during the downturn. There's, you know, increasingly evidence is coming out on this, so it's not sort of entirely conclusive just yet, but you know, it's maybe not a huge surprise that a lot of companies that had protections for their workers, that had, you know, scenario planning, that had, you know, policies around disaster planning, which are sort of things that impact and ESG-oriented investors care about, actually performed better when, in fact, there was a pandemic where, you know, there was a sort of significant threat to their employees. So I think in some ways what we're finding is that while impact investors may not have been measuring and trying to understand those criteria because, you know, because they wanted to achieve a better financial return, actually managing and considering those issues did allow them to achieve a better financial return. And I think there's a lot that we will learn from factors that for a long time impact investors have been looking at and their materiality to the financial performance of the companies that probably we wouldn't have learned about had there not been a global pandemic that sort of forced these things to the fore.
Thank you both so much. I know we're running down to the wire. And I do want to ask you to respond to one last question before we close. And that is in recognition that you're speaking to a group of graduate students from multidisciplinary backgrounds who all have an interest in the topic of impact investing. What types of skills should they be thinking about honing right now to be successful in joining the impact investing industry post-graduation?
I can start, and one thing I'll say is when FSIG started, we were 3 students, so this is kind of incredible. So just acknowledging that the kind of range of interest has grown so much, so I'm really pleased to see that. I think this is a tricky question because it really depends on where you want to play in the impact investing space. And there's a lot of different options, and they require different sets of skills. So the prominent option would be to work in an investment function, but even that would differ quite a lot from one organization type to another. So investing a program-related investment portfolio for a foundation is very different from managing a portfolio at an insurance company, for example. But all of these would require good kind of understanding of financial management, like all of the JAC classes, for example, and strong understanding of accounting and some of the hard skills associated with finance. There's also a lot of roles in the impact measurement space, and this is an aspect of the market that has been growing pretty steadily over the past 5 years. And there's a lot of benefit to familiarity with some of the common tools and resources in the market, so just general industry knowledge. Econometrics would be great. So definitely check out Aker and Schaffner and all of those good folks. And some understanding of finance will be critical there as well, because it's not the same as measuring impact for a USAID or a large entity that has a ton of resources on that front. It's in a inherently different environment, and it'll be really important to understand how impact measurement would play out in an investment firm capacity. And then the third area is where Pete and I sit. We are not with investors, we're not in impact measurement, but we're with a field building organization. And so for me, at least, the skills that come into play are some of the kind of cultural fluency, the interdisciplinary thinking, some of the softer skills that are woven into all of the coursework at Fletcher, and frankly, the group work. One of the things that has emerged as a bit of a theme during the COVID crisis is that collaboration and the ability to collaborate has positioned different players in all these different positions in the market better for success. And so I know group work is a blessing and a curse at different points in time, but it is really important as a skill set. Pete, what would you add?
No, I think Rachel's totally right. I think that's the first thing that I would say. And you know, just working at the gin, Rachel and I both get a lot of like cold LinkedIn messages. Please like do some research on where you want to sit within the impact investing market before reaching out. And then I think reach out to as many folks who are in that part of the market as you can find. But the sort of cold, I want to work in impact investing, what should I do, is sort of a tough starter. So I would say that. And you know, I would also say like persistence is probably key. This is like a space that a lot of people want to work in. Like it's a, you know, the sort of 3 to 20 people on the line and in this club is probably a good indicator of that. And you know, they're always going to be at some of the more commercially oriented shops sort of biased towards a like 2 years in investment banking, then 2 years at a traditional private equity shop, and then you can work in impact investing after you go to, you know, graduate school to learn about impact. Unfortunately, there's still sort of a bias towards that. So some degree of persistence and willingness to like keep going, even if people are like, well, you don't have a traditional background, so maybe think about something else, which is something that I've heard dozens of times in my career in impact investing. So I would say persistence and just maybe accuracy of what you want to do.
I'll throw out 2 more things. One is in industry knowledge, sign up for the GINS newsletter. We don't send it out too much, it's not spam, but it is a good way to just stay abreast of some of the industry developments. It's easy to find on our website. And 2 is we're doing one of the events with OCS in a few weeks. I think it's November 12th, which will be a little bit more of a deep dive on the GIN and some of an industry overview. And so if it's of interest, I think it's open to all Fletcher students. And that'll be another opportunity to explore a little bit more.
Thank you, Pete and Rachel. And I might just plug that Impact Alpha is free for all Fletcher students. So that's another opportunity to stay in the know. I want to thank you both, Rachel and Pete, for joining us, and everybody for taking the time to participate in this really lively discussion. I know that we're a few minutes over, and there's more questions in the chat, and that's just indicative of how much interest there is on this topic. So my heartfelt thanks to Pete and Rachel and to everyone who has joined, especially the professors and administrators and all FSIG members. Please stay tuned for the next FSIG Zoom series. We'll be sending around a newsletter on that shortly. And that concludes the event. Thank you very much.
Thanks for having us, guys.
Thank you.
Bye now.
Bye-bye.
Thanks so much.